Hi, good morning. Good morning to the world. This is MRMD, Model Risk Management Discussion number 21, and it's going to be part one of portfolio model risk. We will start in a few minutes. Just thinking. I think I'm going to go across the room and plug in. Okay, about to plug in. It's 9:03 a.m. in Brooklyn. As I note, it is cold. Feels like it's almost like 2 to 3 Celsius with the wind. That's about 37 degrees Fahrenheit. So that's the reason that I'm wearing this hoodie, my Brooklyn hoodie, kind of baseball themed. So we'll give it a couple of minutes. We are live on YouTube, so you can chat in that. I'll look at the chats afterward, and I'll put up the chat window here so I can see. I'll say hello, world. Please put comments and introduce yourself here. Just a note that I thought I could do this as 1 hour or one MRMD, but it looks like it's going to be two, in which case the second one will be a week from today. There's also an announcement in the talk. I added a few things that I explain what Delta Vega Incorporated is, because I get asked that question a few times. And also, I explained that on Sunday, around this time on Sunday, I'm going to do a special Middle East and South Asia targeted talk. So it'll be in the evening in those places. That sounds like it may be easier for some people to get to. All right, let me get ready to share my screen. Put up this PowerPoint. Yeah, we'll go into slideshow. Okay. See, let's make this look good. Okay. All right, so good morning to the world. We are here on Zoom and also live streaming on YouTube. All of these MRMD talks are live streamed on YouTube, and YouTube also records them for future playback. The end of the talk gives the links to Zoom, the links to YouTube, and also the links to a Dropbox site where I will put the slides and the minutes. I think I put the minutes up, definitely the slides of the meetings. So I'm Jonathan Schachter, PhD. I am the founder of Delta Vega Incorporated, and I am in Brooklyn, New York City, in the United States. So let's give some introduction and sort of the forward of the talk. So MRMD, which you may pronounce mermaid, is, as it says here, a weekly Zoom and YouTube live stream on the subject of model risk management. And I should say model risk management in the sense that we really want to get into the models. We don't want to tell you how to build the models, but you may have to get pretty deep in the weeds on some of these models in order to understand how to challenge them, replicate them. It's directly an outgrowth of my being a co-author on a new MRM textbook, which is the first MRM textbook ever. And in this way, all of these slides are potentially teaching materials for faculty and students. We have a grant from the publisher to provide teaching materials as well as the textbook itself. The working title of the textbook is Model Risk Management, a textbook for financial engineers. I list my co-authors here. It's forthcoming from Academic Press in 2026. So what is Delta Vega Incorporated? It's basically my consulting business. It's a single person business. Tax purposes, it's a New York State S corporation. That means chartered under Chapter S of the United States Internal Revenue Code. And it's been around for about 13 years. I've consulted to some big names, and it also works well with my experience. I worked at Deloitte, and I've managed consultants either individually or as an employee from the other three big four firms, Ernst & Young, KPMG, and Pricewaterhouse. It sponsors, among other things, my LinkedIn rants, which you can look at. I took the last 12 months off to write the book, but now, like a baby, it can be away from the mother for a little bit. And so I'm looking for gigs actively for 2025, when the 2025 budgets come in, interviewing and so on. Appreciate any tips. From my perspective, from how I can help you, is I can explain to you what consulting is like in the US and some of the subtleties of New York State. Of course, if you're from abroad, you're aware that New York is the US financial capital. And so most of the jobs in financial engineering in the United States would be in New York City. And New York City is part of New York State. So I can go into some of these things here and why you might want to have a consulting position and not have a permanent position, or at least to start. I've shown this a few times. This is Big Ben and the House of Parliament in London, just to emphasize that, as you know, the US and Europe, New York and London, for instance, are similar, but not exactly the same. The joke is that the UK and the United States are two countries divided by a common language. I'll say that again, divided by a common language. In the fall, London changes its clocks to summertime, from summertime to wintertime this year on October 26th. So that's coming up. But the US doesn't change until a week later, the first weekend in November versus the last weekend in October. Why do they do this? I don't know. But like I said, we're divided by language, maybe by custom. London, New York, similar in many ways, different in this way. So be aware of this. And of course, the times they are changing. That's right out of the American folk singer and Nobel laureate, Bob Dylan. Just a special notice here that credit, hope you appreciate the cartoon, is something we cover in the book. We covered the counterparty credit risk in a prior MRMD, but now it's time to discuss issuer credit. So counterparty credit risk was largely for clients, some that you can't go out and figure out, are they AAA rated or something like this. So, however, of course, many issuers do have credit ratings, either by the agencies or by bank internal, so-called IRB, internal ratings-based models. This gets into, and the internal ones tend to use things like the constructs of counterparty credit risk, like EAD. I guess that should be LGD. That looks like God. Anyway, it's loss given default, and this is probability of default. So that's going to be a special talk on Sundays. I'm offering this. I tried this before. Maybe we can also do something on Hong Kong time and another one more on, Eastern European, African time, to bring in again countries such as South Africa and Kenya and some of the financial centers of Eastern Europe and the Middle East. But this anyway, you can get to from Abu Dhabi and some parts of, sort of the Middle East. This looks like I never revised the outline. This is from last week, so I think it'll be pretty clear what the outline is. Sorry about that. When I put out the slides, I'll put in the correct outline. Okay, so what are portfolios? Well, I'm going to define it as just two or more financial instruments. And the goal is that you are associating these two and managing them together so that the whole is greater than the sum of the parts. There's a kind of synergy in the sense that there's either better profit or lower risk or both by managing two or more assets together. Sorry, itchy nose. Okay, so an example would be a long short position, vanilla stocks. I think you can come up with these. And some of these simple option strategies like long a share of stock and short a call, or a married put, which is a long put on a stock. So that enables you to sell the price just in case you're worried that it's disaster. I don't think I'm going to go through all of these. I will say that, ALM is an example of managing a portfolio. For example, SVB Bank was unable to manage its liabilities, which were paying investors deposit interest, as opposed to its assets, which were, treasuries, other things more sensitive to the long part of the curve, just because there was no interest rate hedging. And toxic waste, I saw these things, especially leading up to the great financial crisis. CDOs are mentioned here as well. These are technically all portfolios. And the way in which you do it, for example, Gaussian copulas, or, how prepayment works when you're in an MBS, less important than a CMBS, and so on. ABSs with, what was it called? No income, no job. The securitization of subprime mortgages, that's really all within the idea of portfolios. From a quantitative basis, though, it will be easier to largely speak about long equity today. And it's a big enough topic that next week I'm going to cover the more of the long short distress, things like that. But you'll see in the next section that I'm going to do a tutorial on what I call the myths of asset management, including magical thinking. I'll just tell you right off that the return and the risk of that return, let's say the mean and the standard deviation that you're looking at in Morningstar, and unfortunately from your fund manager, if you're in mutual funds, is a very naive type of calculation, and it has to be thought through if you're a serious investor. So that's why the second bullet is on confronting actual portfolios and real statistics to see what really, is the portfolio really being managed properly, or how can we define some new measures such as median versus mean return that may be having fewer assumptions and more realistic about real financial distributions. Then I'm going to touch a little bit at the end of the talk on using time series. I'll just say at the outset, this is one of my favorite things to say, so I have to say it, I guess, every talk, is that history does not provide a useful probability of future events, right? Think of the Titanic. Why didn't it have enough lifeboats? Because they had never experienced a Titanic hitting an iceberg, okay? So, and that's the same way that your insurance company that insures your home and your car and everything, they all are looking backward at the probability of things that happened in the past. The more interesting things on this are pairs trading, although again, that depends on historical correlation, and co-integration, which I'll touch very briefly at the end and expand more in part 2. Okay, so I distinguish between excess returns, sorry, I went past that too quick, and absolute returns. Excess or above something is a difference. Absolute returns is whatever you get. The myth is that you can produce an equity portfolio which provides consistent returns over time, and that the returns are stable over time. So that would mean a fairly constant mean return and a fairly constant standard deviation. You also want the standard deviation to be low and with respect to the return. So that means if you like the ratio, we'll talk about Sharpe ratios later, or the risk adjusted return should be high. What high means, we'll talk about that. There's also a myth that humans can consistently outperform indexes. And unless you're Renaissance technologies or, people really out in the tails, most people cannot perform indexes. One of my former professors, Burton Malkiel, has a whole book about that called A Random Walk Down Wall Street, about how indexation, for an individual anyway, is really the way to go. Despite the fact that the last validity that indexes can be tailored to clients, just invest in indexes is what I'm going to tell you as an individual, but the math is more interesting when we think about the perspective of the managers. So then, the dream would then be that if you can only invest in high quality investment assets, that is removing the non-specific risk or idiosyncratic risk of a particular company. An Enron, for instance, and just that companies are going to largely follow the market. In the ideal case, we would have a lot of observations, but in general, we don't. We have, 10 years of observations, that's N equals 10, and capital N I'm going to use to mean the number of things in the sample. Or monthly, well, how many years? Even back 5 years, N is only 60. And so then in the next set, when we say that we hope that everything is drawn from a perfect normal distribution without any asymmetry or skew, without any fat tails or kurtosis, the only way we're really going to see that is if N is large, like 30 or 40 or 100. And so, looking back 10 years of annual data, as you'll see, is a problem. The other issue is that historical correlation is unstable generally. And so that one has to look at this, and that one also has to look at autocovariance, which is the statement that, often the best predictor of the stock market price tomorrow is the stock market price today. It's like the weather. I just want to say in general, without hitting it over the head too much, that history is like what they tell you in, investing 101. Don't put all your eggs in one basket. Don't put everything in a single model, and don't only look at history. Try to get some predictive ability towards seeing what future behavior will be. History does not usually repeat itself. Okay, so then the metrics that I'll use and the notation that I'll use is as follows. The mean, meaning the arithmetic mean, is mu, and the standard deviation, I assume that most people know what that means. It's the square root of the variance, which is an L2. It's essentially looking at the square differences and taking their square roots, because that way we can count the negative and positive differences to both mean deviations from the mean. We can then distinguish between different kinds of relative returns, just in the sense of how the market uses them. Active return is in the capital asset pricing model sense, which is the return above a benchmark. So Renaissance technologies I mentioned, or let's say you're the best asset manager in the world, and for 100 years you've beat the performance of the S&P 500 by 1%. Well, you'll see that 1% is very kind of subject to a big standard error, as I'll show in a minute. So that may not be a significant result. And then we can also talk about excess return, and that's also a CAPM type of construct, usually relative to a risk-free rate. Like in the US, one could look at annual returns from the S&P or annual returns from an asset versus the annualized Fed funds rate. Fed funds being the rate that the Fed charges for overnight loans when banks need to meet reserve requirements. So you can, annualize Fed funds. It's essentially a risk-free rate in the sense that it's backed by the full faith and credit of the United States government. I'm going to talk less here about absolute returns, but the idea with a hedge fund is to make money in either up or down markets, independent, and not to be correlated. Again, correlated in the future, not based on past correlation. Okay, so let's just talk about returns in general. And the simplest thing I think we can look at in the US markets is large cap stocks. So these results are for 6 different cases, 6 epochs of the Standards and Poor's 500, which you can see from the top is something that's originated from 1928 to the last full year, of course, 2023. That's 96 observations. And the mean of those annual returns is about 8, and the standard deviation is about 19. So these are the types of numbers that we'll look about. We can look, let me just introduce the rest of these. Last 10 years and last 25 years, I think, are pretty important here, just to emphasize, there are numbers that are close to single digits in here, so that, that is a problem. If you're assuming that you're pulling from a normal distribution, you may not have sampled enough to have that. But you can see, for instance, that we've done very well, at least on this chart, for the last 10 years. We've had, especially the post-COVID boom, with less actual volatility than the overall. The depression and the recovery from that was particularly low, but also very volatile, and so on. So the points that I already made, point 1 here, that this is a small number. So it's likely not a normal distribution when you just look at 10 or 7 or 5 years. And it's generally, in practice, skewed to higher losses than normal. That is, the skew is negative and maybe is higher than a 1, which is, I think most statisticians would say, is pretty significant. So there are more losses than there are gains. And there are fat tails. So the tail of the distribution is so-called leptokurtic. The kurtosis is greater than, the excess kurtosis is greater than what would expect for a normal distribution. And so that the depiction of any of these distributions from the first 2 moments, the mean and the standard deviation, is generally not optimal. Refer to previous talks on value at risk and expected shortfall on really understanding the tail. Okay, so here's a naive calculation. We can simply look at these time periods and we can put in this chart. So across the top are annual returns in boxes from 0% to 12%, and here are the returns. So this shows nothing about the standard deviation of the returns. It's just mu. It's mu for each of these 6 instances. Right, so just let's take a breather and just look at this. So that's interesting. The depression was about 1%. I think it was 0 something, right? And the best of these is the most recent performance of the stock market, looking back 10 full years. Okay, so now let's talk about reality. We covered in several talks, beginning in MRMD number 13, that when n is small, there is a sampling error associated with these things, so that these numbers are not really what they may seem. 11%, as we see, could actually be 6%, or even could be 3%, if really the number of things is that small. So this will complicate you when you're talking to your investors if you have to say, well, I made 11% plus or minus 5% for you, right? And it's fairly simple to look at the standard errors. Sampling error or standard error, same thing. Sorry, that's my cat sneezing in the background. But the standard error of the mean is just the sampling error sigma divided by the sample size square root. Okay, so let me just go to I'll take this down for a minute, and now I'll go to a model. What this model is, just a toy model. So in this case, I'm creating 10 years of data. At the beginning, it's 10% constant annual return every year. So it's a fake portfolio. But then we can add in the noise. But 10% is somewhere in the middle of the S&P returns we're looking at. So it's not totally divorced from that. And then we can sprinkle in noise. So we can then draw from a distribution which has 0. So that would be 10% every year. Or we could crank it up to 10%, 20%, 30%, which is what we saw in historical S&P. So the question then is, what is the observed return of, will you really see 10% return if the actual distribution is 10%, but has a lot of noise? It turns out that you may observe negative return even though it's 10%. And you may observe substantially less than 10% or even zero. So, if you ask the question, are we making money for the client? Maybe yes, and maybe no. So here's the spreadsheet. My former life, I was an astrophysicist, and in physics and in hard science in general, without being too patronizing of social science and economics, data has error bars, right? It's not just the mean, but there is some error that's put on that. So the fundamental chart is over here. As you can see, on the left, I have my fake 10 years, and then various quantities. Let me just stick of 2 through 12 here before we get to the green one here. And across the top is sigma, which is the noise that I'm sprinkling in. So these are random. I can just show you if I hit F9 that this is an active spreadsheet. So the numbers will change each time we're doing a random draw. Down here on row 13, we're going to calculate what the mu is that one would observe. So you can see at 30%, even though it's 10% drawn from a 10% mean, you have a negative 6% for this instance because of all this noise, right? And this is the kind of noise that you had at the time of the Great Depression. Okay, now to balance that out, there is this standard error of the mean. And that's given in the orange chart here. I know there's a lot of information on this page, so take from it. If this is not useful, then look here. Okay, so here's the noise, 0 to 30%. Here is the mean return, and here is the standard error of that return. So, for example, if I hit 9, you can look at the red table now. You can see the numbers are changing. And if you like, you can also look down here, which is showing. So in this instances, you can see that the return is a decreasing function of the noise. The more we turn the noise up, the more the return goes down. On the left axis here is mu, and on the right axis, on the horizontal axis, is sigma.
Okay. Jonathan, which row is the random recalculated number?
Okay, so all of these are random. There are hidden rows where I'm drawing from the distribution, but all of these are drawing from, so for example, this point here is drawing from a distribution of mean 10% and standard deviation 5%. Right? So if I hit F9, if you look at that number, it'll change as I keep drawing from it. So now it's 10.26%. Right? So these are all random. It's all fake data, but each number in this is a random draw from a distribution where the underlying distribution has a mean of 10%, but each year you pull from the distribution and give it a 5% standard deviation. Does that make sense?
Okay, I can't. So B3 is hidden. B3 is something that's got a random number.
Right. So I can expand this, sure, and I can make the spreadsheet available. So we start. How do you generate random numbers? Well, you do the usual thing that you take the inverse of the standard norm of the uniform. So there's a there's a numerical approximation to the inverse CDF of the Gaussian. So that gives you this, and you can see, so you're drawing from something with approximately 0, 1, 0 mean, standard deviation 1. You take the mean, and then, this is basically just, right, the standard thing that the way you make a normal distribution of mean and standard deviation non-zero is you add the mean, that's C3, 10%, and then you multiply by the standard deviation.
Thank you.
Yeah. There are other ways to do it. I did it in Excel, maybe it's easier to understand in Python, but okay. So you can play with this. I'll put this up. All right. So, it's a real question. Are you really making money for the client? Okay, and let me put this back to slideshow so I think it's easier to see. And let's go back. Okay, so now we have this chart before where everything looked nice. Now let's put the standard errors in for each of those epochs. So the muse here, it's the same chart. It's the same 6 epochs, excuse me. But now I've had to expand the scale in the horizontal dimension because now I don't know why this white thing is here. There's a couple of weird things in here, but anyway. So it was 8% before, but with the standard errors, even looking at 96 years, we could actually achieve anything within one standard error between 6% and 10%. Okay. And 2 standard errors. So that's really probably corresponding to only 2/3 of the time that we're in here. Another 1/3 of the time, we could be in here in the 2 or 3% or in the 11, 13%, just because this is a distribution. When we have fewer data points, like 10 years as opposed to 96 years, of course, there's an even greater, possible deviation. And the depression, I think, was my smallest one. That was about 5. No, like the smallest one's the .com. Anyway, you can see a couple things from this. That that by sampling these distributions, you can't just look at the mean, okay? And in fact, every epoch from the Great Depression to the .com boost to the last great 10 years, every epoch is consistent statistically with either 6% or 7% or 8% or 9% or 10%. So if someone tells you that they're getting 8%, in their portfolio from 10 years or something of data, you really got to ask them, what's the standard error of that? Because you may really be only making 5 or 6% when they say 8%. Now, maybe what this shows, I think we already said that there's skew and kurtosis, that using a normal distribution as an assumption is wrong, right? We say that there is skew and kurtosis. So sorry? So let's do some things that don't assume anything about the distribution. The median of the distribution is the same as the mean if it's normal, but it's not the same if it's not normal, if there is skew and kurtosis. So it's more robust. The median is just the number right in the middle. Between 1 and 11 of integers, the median is 6. Right. So is the average, but that's because that's equal spacing. And then I'm going to say L2 and L1 a bit here. I think I've already mentioned it. When I say L2, I mean that you're taking the square root of the sum of squares. When I say L1, it's ordinary differences without a square. So absolute value. So it turns out that taking 1/n of the sum of the absolute values is more robust. It's just not usually done in the stats literature because absolute values, you can't do calculus with, you can't take derivatives of absolute values and things like that. But L1 is actually a better thing to look at. And this is called the MAD, the mean absolute deviation. So each observation, let's say each of those 10 observations, you difference it with the mean, and then you take the absolute value and sum them and divide by the number of observations. So that's why I say it's the L1 equivalent of sigma. Sigma is 1/n, is the square root of 1/n of the sum of the squares of the differences from the mean. All right, sorry. Trigger button. Now, there are other things that, again, for general distributions, one should look at. Don't assume normal. One is just the minimum and the maximum return for the period. And then you can look at percentiles. This is a little bit like what we talked about with PFE and with VAR in previous talks, that the 99th percentile was looked at. That I quickly found that I can't look at the 95th and 99th percentile because only one of the data sets even has 95 points. So instead, I'm looking at, I don't know if you want to call these quintiles, because there are 5 of them. So I'm looking at the lowest quintile and the top quintile, the 20% and 80% points. So, here's a recalculation of the S&P results for these more robust measures. So I would say in this case, one thing that sticks out, so the median, the mean absolute deviation, the L1, the minimum, the maximum, and the 20th and 80th percentile. Sorry, I think it was hard to get Excel to put percents in here, but these are all percentages. So, it's very clear here that the Depression has the worst median return. Right. It also has the worst minimum return. Is that right? No, but it sticks out because it's pretty bad. Yes, here it is, 47. I was looking at the wrong line. It is the worst and the worst 20th. Whereas the last 10 years had the best minimum return of this set and the best 20th percentile, lowest loss. Okay, now let's talk about arithmetic, where standard errors also come into place, but the types of quantities that asset managers do. So as we said before, an asset manager will say, I'm benchmarked to the S&P. I can do better than the S&P. And the way that I'll measure that is by my mu. We're using that universally to mean the annual return is better than the annual return from the S&P. So of course, the shareholder or client asks, did you outperform the index or not? And the manager wants to show that they outperformed it. And indeed, that they outperformed it enough that the management fee that they collect, or the commission in the case of an ETF, is worth it. Okay, so here are a couple of problems. First of all, these individual means have their own standard errors, right? And the portfolio, if you're looking at 10 years, is going to have the same issues as the S&P. In fact, it may be even worse. There may be more noise in a, let's say, pick 50 stocks. You probably don't have 500 stocks in this portfolio. So you're starting at an even higher standard error. Second, there's an L2 addition, that is the sum of squares addition of the standard errors. I show this here. There's some units issues here. So for real, what's happening is you're adding sums of squares of relative errors. So it's really the error divided by the mean and the error, try to get back, in each case. But that's okay. Let's say that we can re-express. The point is that the difference is going to can have a substantially amplified standard error relative to the individual ones. As an example, let's say that the portfolio has a 10% standard error and the Standard & Poor's has a standard error. Well, then the total standard error of the difference is the square root of 2 times that, which is 14%. So, this is something you definitely want to look at. Now, excess returns, slightly, you do slightly better, because in this case, the portfolio, let's say in the capital asset pricing model, is relative to Fed funds. And Fed funds, you have a lot of data. It's pretty stable. It doesn't change very much. To generate the Fed funds in the data I'm going to present, I took daily Fed funds and I averaged it over 250 days. So that's, 2.5 times any sample size that we've discussed in the so far, right? So therefore, there's a low standard error in that. That is less of a problem than when you're differencing the portfolio with the S&P. I introduced some new notation here that mu XS is the difference between the portfolio and Fed funds, or whatever risk-free rate you look at. And then we can define a sigma of XS, which is the standard deviation of the difference, right? Now, I discussed in MRMD number 13 that the standard error of the standard deviation is complicated. It's got gamma functions and things in it. Again, because of L2, the variance is easy to write down. It's standard error. But the standard error of the square root is not the square root of the standard error because of convexity. So that's why the gamma functions come into play. And you can refer back to number 13 for the closed form of that. But essentially, the quantity that's often used is mu of the excess return over the standard deviation of the excess return, right? Well, again, that's going to amplify the individual standard errors in the mean and this time in the standard deviation, right? So that the standard deviation of the Sharpe ratio is going to be larger than either the standard deviation of the numerator or the denominator. Right, so what does that mean? Well, so here, I'm not going to show you before and after. First of all, forget these purple squares. I don't know how they showed up there. Basically, this is a little bit like the returns chart that on the left axis, I'm showing now I only show 5 periods because, see, Fed funds doesn't go back to 1928. It only goes back to 1955. So some of these samples are smaller. And then this is a range of Sharpe ratios between minus 0.5 and 1.4. In each case, the S is showing you the mean Sharpe ratio, and this is showing you the standard error in that, right? So as you would expect, again, the smaller data sets like the last 10 years, you can pretty much get whatever Sharpe ratio you want, right? In fact, just like a wide range of returns was consistent with the data in a previous one, a wide range of Sharpe ratios, even negative Sharpe ratios in some case, are consistent with some or all of these epochs, right? For example, a negative S, a negative Sharpe ratio, could occur, is consistent with the Great Financial Crisis. But the last 10 years clearly are the opposite, and they even have Sharpe ratios greater than 1, which I think is kind of unheard of. All right. And then I can see it's getting close to the hour, so I do want to cover a little bit on time series. Standard equity models are a little bit closer to the idea of excess return above a risk-free rate. Here, now we can talk about either a single asset or a portfolio. So I'll call it asset I has an excess return above the Fed funds rate. And I can define a market portfolio, which could be like the S&P. So in this case, I can calculate what's defined as beta, which is the covariance of that. It's the correlation of the asset with the market. So for example, a beta of 1 means that a 1% change in the S&P 500, if that's what the market is here, will be reflected on average as a 1% gain in your stock. A beta of 2 means that a 1% change in the S&P will be reflected on average in a 2% gain in your stock. And so then just to, sorry, really, my fingers are really doing the walking. So basically, the capital asset pricing model says that it is possible to relate the observed return, excess return of that asset above the federal funds rate in this manner, writing it in terms of the Fed funds return, beta, and the market return. So this is so-called beta. In the next talk, we'll talk about alpha, which is, Fama French and some other models where they understand that that you may be able to get more out of the market than just by following an index. Okay, let's talk a little bit about time series, maybe 5 or 10 minutes, and then I can leave some time for questions. So why do we look at time series to begin with? And what is a time? Well, it's basically just, an Excel 2-column chart with dates and values of a quantity, like the annual return in the S&P 500. But typically, especially when you look at some hedge fund strategies, you might be looking at grainier data, like daily data or monthly data. And the idea is that somehow you can cook up a strategy so that you can make some money from the changes in history. Again, we have no guarantee that those historical changes, just like the Titanic, are going to continue in the future, but we can try. right? So this is when it gets into econometrics. It also is, time series is more applicable to things like large language models within the context of AI. We're looking for patterns. So probably the easiest example to explain is just pairs trading, like two stocks which have a stable historical correlation. Again, there's no reason to assume that they will have a stable forward correlation, but let's just ignore that. Let's do this blindly. Just to, I sort of said this a few times, but generally using the historical measure is what your insurance companies do, right? That's how they judge what your premium should be for your home. That's how they judge, what happens if a hurricane hits and things like that. They're just looking at the past. Literally, the Titanic did not have enough lifeboats because there had never been a Titanic. There is no sense in actuarial science, including life insurance, of trying to predict what the future will be. It's all based on the past. It's all, sorry, but it's all ass backwards. So, for example, it's interesting to know that Zillow has just rolled out something, I think it's a 4-factor model, that can introduce some kind of climate cost if you're buying a new home. But guess what? It's all ass backwards. All of those things are based on past hurricanes. And guess what? If you're in the area where Hurricane Milton just hit, you're going to have higher rates. Now, is Hurricane Milton going to hit every hurricane season for 1,000 years? No. So this is an example of how these actuarial methods and insurance in general is, you might be better off just sticking your finger into the wind. You can't predict the California earthquake on the basis of the past history of earthquakes. So, but let's just forget about all that. Obviously with two stocks, if they negatively correlate, then you can go long both of them. If they are positive correlated, you can go long short. And then, do a full-blown simulation. Do it, okay, use the historical correlation. But understand that those returns have standard errors, right? And again, you're using a differenced return if you're going long short, and challenge the correlation assumptions. Put in shocks to the correlation. Make all the correlations go to 1 as they do in a crisis. Shock it, include the effects of skew and kurtosis on the correlation, something I haven't mentioned, but that's something that we cover in the textbook. That correlations, if you start with a normal distribution, and then you start adding in some skew, then the observed correlation is not going to be what it was without the skew. Okay, so we'll go just a little bit deeper into time series. So, for example, we talked in prior MRMDs on the idea of mean reversion and stationarity, on differencing to create stationarity, or conducting a ordinary least squares and removing a trend. If you have not already worked on things like ARIMA or autoregressive models or moving average models, then this is probably a good time, if you want to get some more insight, to go into that and look at things like the autocovariance function and the cross covariance function, as well as the structure of the variance covariance matrix over time. These will become more important in the next talk, which is going to cover such topics as stat arbitrage. But I did want to introduce, and this is the last kind of slide with any physics in it, the idea of co-integration. So it's rare that you're going to find two stocks which have, a beautiful 1% stable correlation, or even 50% or negative 50% correlation. But co-integration is an important property in that one or more series can be combined so that the portfolio is then stationary, right? For example, let's say that you take a couple of stocks and you look at them and you look at their returns, and now difference them. So differencing is, there's an isomorphism between series and between polynomials. So the stationary produced by degree 1 means that there was a linear trend. If it needs two differences to be stationary, it's a quadratic trend, and so on. So that if the differencing essentially is done D times, then it's co-integrated to the effect of D, and then you can essentially, co-integration is a direct extrapolation, if you will, from stationarity. It basically means that the Toon-Seibe series, in this case, I call them X and Y, can be combined in some way, a linear combination. And then you can apply the stationarity test that we discussed in previous MRMDs. And this linear combination describes how the two interact. And then you can, at least based on historical data, have some idea of how you would manage them. All right. So I see we're almost out of time. Let me just say that this is the joining information. Let's see. This kind of something got put on top of the other. Little out of sorts today, I guess. But basically, this is giving you the Zoom links, the YouTube, encouraging to subscribe, and that as referenced before, these slides will shortly be put up on the Dropbox site along with the rest of the slides. This is the last slide, and these are my contact points. So then I'm going to stop the share. And I know Greg is on, and anyone else who's on YouTube. See, can I try to get I'll put the chat window up. We'll put it up in one way. Okay. So for Greg or Greg, if you don't have an immediate question, give me a minute and I'll try to see if I can get the YouTube chat window up. YouTube. Share that. Question, give me a minute and I'll try to see if I can get the YouTube chat window. Oh, no, I didn't want to pause it, but I want to mute it. Okay. All right. So here's the live chat here. Maybe I can't get the chat window up. If I can't figure this out in a second. I don't know why I can't open the chat window up. Anyway, sorry, you guys have my contact information if you want to ask questions. You can usually get the chat window up. I also will post the minutes of the meeting. But the idea was at least to cover this as the basics of the way that we would like junior financial engineers to think about portfolios. I should say from talking to friends at hedge funds. Well, okay. So in one sense, this chapter is like a unicorn in that it stinks out in the book. That asset managers like a Fidelity or a Putnam or Vanguard are not subject to, they're not national banks, such as would be covered by the OCC, and they're definitely not bank holding companies, such as would be covered by the Fed, so that they are not subject to the Fed's and OCC's SR 11.7 OCC 2011-12 model risk requirements. On the other hand, the better banks, and I think life insurance companies as well, the better asset managers do have something like a model risk understanding. I know when I was at Goldman Sachs Asset Management that a lot of attention was paid to things like if you compare to a portfolio, it's not just the return that you make relative to the S&P, but it's also the volatility that you have relative to the S&P. And within the Black-Litterman models, this was actually in Bob Litterman's group at Goldman where I worked. So within those models, what are the problematic things in your portfolio that are causing it to not get the required return, or giving you the volatility but not the return relative to the benchmark? Those are called hotspots in the Black-Litterman model. Hedge funds, I think, have CROs, but I don't, I think being a CRO in a hedge fund is like being a weatherman in San Francisco. The weather is the same 364 or so days a year. So there's not much that risk managers can do. The traders and the portfolio managers are the ones who make the risk decisions. I can say that having known a guy who worked for John Paulson's hedge fund empire. Okay, we're almost at the top of the hour in Brooklyn, so um, I think I can give you guys a few minutes back to get on with your day. I touched on it briefly before, but it's pretty cold here. So you people who are listening to this live on YouTube or listening to this as a recording, I'm jealous if you're living in a part of the world such as India or somewhere in the tropics where it's warmer than what it feels like outside, which is about 2 to 3 degrees Celsius or 36 or 37 degrees Fahrenheit when the wind gusts are taken into account. We are definitely moving toward winter in Brooklyn. All right, so I will end the meeting. I'm going to fix the table of contents in that slide and post it shortly with the minutes. And then once again, the next of these is going to be not on a Wednesday at 9 a.m., but it's going to be this Sunday at 9:30 a.m. so that it can be seen in the Middle East and South Asia. We will be back in 1 week, and that will be the second and final part of this talk on portfolio risk. So thanks everybody for your attention. Please reach out, follow me. I accept most LinkedIn requests for people who are, I think would benefit from connecting to me, and you can certainly follow me. Thanks. Have a nice day.